Welcome to the deep dive. We're here to take those dense, often intimidating corporate filings and, well, make sense of them for you.
Make them clear, concise, and hopefully actionable.
Exactly. And today, we're tackling a big one in the Turkish energy sector, Zorlu Energy.
Yeah, and this isn't just, your standard power company story. We're looking at a company that's really in the middle of a major shift.
A repositioning, you could say.
Definitely. They're moving away from some traditional areas like distribution that they sold off and exiting certain international assets
Right.
and pivoting hard towards domestic renewables, especially geothermal, and that whole high-tech electric mobility space with ZES.
Absolutely. So when you crack open their consolidated financial reports,
Yeah.
we're looking at the first 9 months of 2025, ending September 30th, and comparing it back to the same period in 2024, you see it immediately. It's not just business as usual.
No, it's like watching a major portfolio reshuffle happening in real time, billions of lira moving around.
So our mission today, and this is really aimed at you, the individual investor trying to understand this company.
Is to cut through all that financial jargon, all the complexity in the balance sheet and the activity report.
Right. We want to figure out the true financial health, the real strategic direction, not just what the headlines might say.
And crucially, we have to keep reminding ourselves and you that every single number we discuss today has been adjusted for inflation.
That's TMS 29, the inflation accounting standard.
Exactly. Everything's stated in terms of the purchasing power of the Turkish lira as of September 30, 2025.
Which is so important for getting a real comparison, isn't it? Otherwise, inflation just distorts everything.
It really does. It lets us see the real economic performance, the genuine wins, and, well, the challenges hidden in those figures.
Okay, so that inflation adjustment is key.
Yeah.
Stick with us for this deep dive. We think you'll find it valuable.
And if you do, please, take a second to click like, maybe share it with someone else who follows the market, and definitely subscribe for more content like this.
Couldn't have said it better. Right, let's get started. Okay, first things first. Who is Zorlu Energy? Let's get the basics down. What's their main business? Where do they sit in this, very competitive Turkish energy market?
Well, they're not a new player. Zorlu Energy was set up back in 1993. It was founded by Zorlu Holding itself and Cortex Mensuket, another big name within the group.
So ultimately part of the larger Zorlu Holding conglomerate.
Precisely. They're headquartered over in Bursa, in the Fethi Organized Industrial Zone, Fethi OSB Mahallesi. And they've been listed on the Borsa Istanbul, the BIST, since way back in 2000.
So a long track record as a public company.
Yep, which gives them visibility. But day-to-day, strategy-wise, it's Zorlu calling the shots.
Their business lines. It seems like they try to cover a lot of ground.
They really do. It's classic vertical integration, almost. They're involved in electricity production, obviously, but also steam generation and sales.
That's from their cogeneration plants, right?
Yeah. Exactly. Then you've got electricity trading. They used to be big in distribution, but sold most of that off. Some retail sales.
And then newer stuff.
And the big focus for the future, electric vehicle charging stations and services. That's primarily through their subsidiary ZES, sometimes branded as Electric internationally, and also some EV leasing via eWay.
That EV charging piece, ZES, that really seems to be a key differentiator for them compared to maybe more traditional utility.
It absolutely is. It signals their bet on the future of mobility, not just power generation.
Okay, let's talk ownership. This is important, especially with all the big investments and financing they're doing. Their total paid-in capital is 5 billion Turkish lira. How's that structured?
Right. The ownership breakdown as of September 30, 2025. The public float, the Halka Ars, is actually pretty substantial. It's 37.40%.
So a good chunk is freely traded.
Yeah. Then the major holders are Zorlu holding Aish itself with 32.31%. Cortex Mensuket, the founding partner, holds 17.5%.
And interestingly, there's a big international infrastructure fund involved. Wren House Infrastructure LP. They hold 12.34%.
Ah, Wren House. That's significant. Having a major global infrastructure investor like them on board, that's a real vote of confidence, isn't it?
It definitely signals external validation for the long-term value of their assets, especially the renewables, I'd imagine. It's a confidence booster for other investors, too.
Good point. Okay, so where are they actually making the power? What's their physical footprint look like?
Domestically, in Turkey, their total installed capacity for electricity generation is 608.45 megawatts.
Okay.
Plus, don't forget the steam capacity, 98 tons per hour, which is quite significant, from their natural gas cogeneration plant.
Right. But the main story, especially for the profitability, is renewables, isn't it? Specifically geothermal.
Geothermal is definitely king in their portfolio. It accounts for 305 megawatts.
Yeah.
That's primarily from their big plants like Kajil Ray and Al Shahir.
And that's crucial because geothermal provides stable baseload power. It's not intermittent like wind or solar.
Exactly. After geothermal, their next biggest is wind power, with 135 milliW, mainly from the Giksada wind farm.
Brooksta, right.
And they also have a decent chunk of hydroelectric capacity, about 118.92 milliW, plus a smaller natural gas cogeneration plant at 49.53 milliW.
So it's a pretty diversified domestic base, but heavily weighted towards those high-value geothermal assets. And those assets benefit significantly from government support schemes, which we should probably touch on later.
Definitely. We need to talk about Yekenem. Now, what about internationally? You mentioned they're exiting some areas, but ZE Electric has global ambitions, right?
Yeah, their actual foreign production capacity is pretty small now, just 57.90 milliW total. That's a wind farm in Pakistan and a solar plant in Palestine.
Okay.
But the real international play is ZES, or Electrip as it's often branded outside Turkey. They've built this network of subsidiaries not just across Turkey, but they're expanding rapidly into the EU. We're talking the UK, France, Germany, Italy, Spain.
So the strategy seems to be use the cash flow from the stable Turkish renewable base
to fund the rollout of this global EV charging network, which is, potentially a much higher growth, higher valuation business in the long run.
Right. A company this size, this complex, needs good management. Let's look at personnel and leadership.
Mm-hmm.
I noticed in the report that the average number of employees actually dropped quite a bit.
That really jumped out at me, too. The headcount went from 2,107 people at the end of 2024 down to 1,913 by the end of September 2025.
That's nearly a 10% reduction in just 9 months.
Yeah, and I don't think that's just, simple cost cutting. It really suggests a strategic shift. They sold off the distribution business, which was quite personnel heavy. And they're focusing more on capital intensive, maybe more centralized operations like the geothermal plants and managing that ZES network. It points towards a leaner, perhaps more focused organization going forward.
Makes sense. What about the board? It looks fairly standard, 7 members, chaired by Ahmet Natsif Zorlu. Includes 3 independent members, which is good governance.
Yep, standard structure.
How about female representation on the board? That's something investors are increasingly looking at.
They actually do reasonably well there. There are 2 women on the 7-member board, Betul Ebru Eden and Selin Zorlu Melik.
So that's what, about 28.57%?
Exactly, which is, frankly, a pretty strong percentage compared to many other large industrial companies listed in Turkey. It's noteworthy.
Okay. And finally, before we dive into the strategy shifts, executive compensation. Always important to check.
Right. So for the first 9 months of 2025, the total compensation paid out to board members and the top executives, remember, inflation adjusted, came to 122,016,000 TL.
That sounds like a big number.
It is, but the report notes that the General Assembly sets specific fees only for the independent members and 1 non-executive member. So there's some separation between fees for governance oversight and operational salaries.
Okay, so it's a fixed cost we need to factor in when we look at their overall cost structure,
Yeah.
but there's some governance structure around it.
Precisely. It's part of the operational overhead.
Right, now let's get into the really interesting part, the big strategic moves. All those asset sales, the restructuring, it feels like it was all building towards something specific.
I think that's exactly right. This 2025 report is dominated by this narrative of a strategic pivot. Management seems to be very actively selling off mature, stable assets.
To raise cash.
To raise cash, yes, but for 2 main reasons. Tackling that huge pile of debt, which we'll get to, and funding this shift towards new, high-growth domestic projects and ZES.
Okay, so the headline event for 2025 in terms of asset sales was definitely the Dorad deal in Israel.
Absolutely. That marked their complete exit from electricity production and sales in Israel.
They sold their remaining 25% stake. What was the real significance of that sale, beyond just getting out of Israel?
Well, the cash was significant, obviously. They completed the sale in July 2025 for about 707 million Israeli shekels. But strategically, Dorad was one of their few major assets outside Turkey.
So it provided geographic diversification?
Exactly. It had different political risk, maybe more stable regulatory environment compared to Turkey at times. By selling it, management basically sent a very clear signal. We're prioritizing domestic investment, focusing our capital on the Turkish energy transition, even if it means giving up that international stability.
A very deliberate choice.
Ah.
And the financial impact, That must have given the P&L a boost.
A massive boost. The sale generated a profit of 7.6 billion Turkish lira. That's 7,617,047,000 TL.
Wow.
But, and this is crucial for you as an investor to remember, that's a one-off gain. It's booked under investment activities income. It's not from ongoing operations.
And it's not recurring.
Not at all. But it provided an absolutely vital one-time injection of cash and profit that, as we'll see later, really helped to mask the pressure from their enormous finance costs.
And just to put that 7.6 billion gain in context, we should probably quickly remember the big sale from the previous year, right?
Good point. Because it shows a pattern. In the 9-month 2024 figures, the comparison period, we saw that huge gain from selling Zorlu Energy Dağıtım, their distribution arm.
How much was that again?
That sale yielded a profit of about 5.8 billion lira, 5,814,899 KTL, which was categorized back then as discontinued operations income.
So add those two together.
You're looking at over 13.4 billion lira in profit generated from selling off two major stable businesses distribution and the Dorad stake in less than 2 years.
That's a huge war chest they built up.
Exactly. Funding both debt reduction efforts and this big strategic pivot we're talking about.
Okay, so if they raised all that cash, where'd it go? The report shows a massive jump in total investment spending, up to nearly 4 billion lira. 3,958,368 KTL in the first 9 months of 2025. That's like a fourfold increase from the same period in 2024.
It is a huge acceleration, yes. It definitely shows they're putting that cash to work quickly. Now, the breakdown is a little interesting. The big chunk is listed under Müşteri Sözleşmesinden Dozan Varlıklar,
which translates to assets arising from customer contracts.
Right. And typically that relates to investments in the distribution network, things like grid connections, meters, etc.
But wait, didn't they sell the distribution business? Why are they still investing heavily in distribution-related assets? That seems confusing.
It is confusing, and it's something investors need clarity on. There are a couple of possibilities, I think. One is that even though the main business was sold, maybe the sale agreement required Zorlu to complete certain mandatory network investments that were already underway, sort of a trailing obligation.
Okay, that makes some sense.
The other possibility is that it relates to some retained rights or guarantees connected to the future performance or expansion of that network, even after the sale. Either way, the key takeaway for you is that a chunk of this big investment number is likely a residual cost from exiting distribution.
Right, not necessarily new strategic investment.
Exactly. The truly strategic money seems to be flowing into upgrading their core production assets and building new capabilities.
Okay, let's talk about those core upgrades. Hybrid renewables and energy storage seem to be the buzzwords.
They are. The hybrid model is about efficiency. They're adding solar panels, GES, Güneş Enerji Santrali, onto the land at their existing geothermal and wind power plant sites.
Like at Kızıldere and Gökçeada.
Precisely. Kızıldere 1, 2, 3, Gökçeada RES. By adding solar, they can use the existing grid connection, the existing permits, and basically squeeze more kilowatt hours out of the same piece of land. It optimizes the infrastructure they already have.
Smart. But the really exciting part, the potential game changer, seems to be energy storage.
Oh, absolutely. This is where they're trying to future-proof the business, especially those high-margin renewable assets. And they're moving fast.
How fast?
They have active applications submitted for a total of 500 megawatt electric MRE of independent battery storage facilities. That's huge.
Wow.
And on top of that, they're planning integrated storage projects linked directly to specific power plants. There's a 250 millidarya storage project planned alongside a wind farm at Yunusiflik and another 125 milliW at Armitbat.
So what does adding all this storage actually let them do?
It lets them play the arbitrage game. When demand is low and electricity prices are cheap, maybe overnight, when the wind is blowing strongly, they charge the batteries.
Okay.
Then, when demand peaks during the day and prices spike, they discharge the batteries and sell that stored energy at a much higher price. It maximizes their revenue from the energy they produce and also helps stabilize the grid. It directly supports maintaining those high EBITDA margins we'll talk about.
Now, they're even setting up a new company structure to manage all this complexity, right?
Yes, that's important too. In August 2025, they established a new 100% owned subsidiary called Zorlu Dengelemeve Enerji Yönetimi Aşı.
Which means Zorlu Balancing and Energy Management, Inc.
Exactly. Its whole purpose is electricity trading and holding an aggregator license. This positions them to actively participate in the balancing market, optimize their storage assets, and basically extract the maximum possible value from being flexible.
So it's not just building the batteries, it's building the commercial capability to use them effectively.
Precisely. It's the whole package.
What about innovation? Are they investing in R&D to support this shift?
They are. The total R&D spend for Zorlu Energy and OE the remaining distribution-related entity, reached about 78 million lira, 77,073 KTL in the 9 months.
And where's that R&D money focused?
Very strategically, it seems. Key areas mentioned are smart grids essential for managing renewables and storage improvements to EV charging infrastructure to support ZES,
Makes sense.
and also a really interesting project called Jeski, which is focused on injecting carbon dioxide back into geothermal reservoirs.
Ah, carbon capture and storage, but for geothermal.
Kind of. If they can successfully implement the CO2 injection, it significantly improves the environmental profile, the sustainability credentials of their biggest asset-based geothermal, which in turn helps with things like ESG ratings and, importantly, refinancing.
Speaking of refinancing,
Yeah.
we absolutely have to talk about that massive $1.1 billion Eurobond deal. That felt like a structural lifeline for the company.
It was a huge transformative event for their balance sheet. It happened mostly across late 2024 and early 2025. A total of $1.1 billion raised.
And the purpose? Primarily paying off old debt.
Mostly, yes. About $262.5 million was used specifically to call or pay back early an existing bond issued by the renewables subsidiary Zorlu Yenelia Nebulier.
Okay.
The rest, the larger chunk of $737.5 million, was used for general refinancing of other existing financial debts.
So the key outcome was pushing out maturities.
Exactly. This deal successfully extended the repayment deadline for a huge chunk of their debt way out to 2030. It dramatically reduced the immediate pressure, the near-term risk of having to refinance large amounts in potentially difficult market conditions.
Huge relief for them, presumably. Now, the report mentions it was a sustainability-linked Eurobond. What does that actually mean in practice? Are there real teeth to that?
Yes, there are. This is really important for investors focused on ESG. Sustainability-linked bonds, or SLBs, tie the interest rate the company pays to achieving specific, pre-agreed environmental, social, or governance targets key performance indicators, or KPIs.
Okay, like what kind of targets for Zorlu?
Well, the exact details would be in the bond prospectus, but typically for an energy company like Zorlu, the KPIs might track things like the percentage of their total power generation coming from renewable sources, maybe their overall greenhouse gas emissions intensity, like CO2 per megawatt hour, or, very relevant for them, targets related to the expansion of their ZES EV charging network number of charging points installed, for instance.
So it's measurable stuff. What happens if they miss those targets?
That's where the teeth come in. If Zorlu fails to meet these predefined sustainability targets by a specific measurement date set out in the bond terms, the coupon rate, the interest rate they have to pay on that $1.1 billion bond automatically increases.
So it costs them more.
Yes. Usually there's a pre-agreed penalty, often a step up of maybe 25 or 50 basis points, that's 0.25% to 0.50% added to the interest rate for the remaining life of the bond.
So it creates a very real financial incentive for them to actually deliver on their green strategy, on expanding ZES,
Right.
on reducing emissions. It links their strategy directly to their funding costs.
Exactly. It aligns management's strategic goals with the financial interests of those bondholders. It's a powerful mechanism.
Okay, let's pivot slightly just to ZES Electric for a moment. That's their big international growth engine, right? What's the competitive edge there, and is it actually making money yet?
ZES and its international brand Electric is all about building out that EV charging infrastructure across multiple countries. It's very capital intensive, requires a lot of upfront investment.
What's their edge?
Their edge, I think, comes from being an early mover in some of these European markets and also leveraging the existing infrastructure and logistics support of the wider Zorlu group, which already has operations in many of these places.
But that EV charging market is getting crowded fast, isn't it? Is it really profitable right now?
That's the key question. Right now, probably not very profitable on an operating basis. It's high investment, relatively low utilization in many places still, and lots of competition pushing down prices.
So why do it?
The bet is on future growth. The value proposition isn't immediate cash flow. It's capturing market share, building the network, and hoping to achieve dominance. The potential valuation uplift for a successful, large-scale EV charging network is enormous. It's seen as a high-tech infrastructure play.
So it's a risk-reward calculation.
Absolutely. They sold stable, income-generating assets like Dored, partly to fund this high-risk, high-potential reward expansion of ZES across Europe. Whether that gamble pays off? Well, that's what investors are watching very closely.
Okay, we've set the scene with the strategy. Now let's follow the money. Deep dive into the financial statements, balance sheet, income statement, activity report for those first 9 months of 2025. And just a reminder for everyone listening, all these numbers are inflation adjusted using TMS 29.
Crucial point. So starting right at the top line, revenue, or hasılat as it's called in the Turkish reports. What happened there?
It actually went down. Revenue decreased from about 27 billion lira, 26,974,022 KTL in the first 9 months of 2024,
Yep.
down to 23.9 billion lira, 23,903,475 KTL
Yeah.
in the same period of 2025. That's a drop of around 3 billion lira in real terms.
Right, and that reflects lower volumes, doesn't it? The report mentioned electricity production was down 5% and commercial sales down 1%.
Exactly. Part of that is likely due to selling off the distribution business, which would have contributed significantly to revenue previously, even if it was technically discontinued.
Makes sense. But here's the interesting bit, the paradox, really. Revenue went down, yet their gross profit brute car actually increased.
Increased. How much?
It went up from 3.47 billion TL in 9M 2024 to 3.68 billion TL in 9M 2025.
So lower sales but higher gross profit. How does that work?
It means their gross margin got better. It improved from around 13% to 15%.
Okay, why? Better prices.
Not necessarily prices. It suggests their cost of sales fell even faster than their revenue did. This points towards improved efficiency, maybe better cost management in the core assets they kept.
Or maybe the assets they sold off were lower margin.
That's very likely part of it, too. Shedding the distribution arm, which might have had thinner margins, and focusing on the higher margin production assets like geothermal would naturally lift the overall gross margin. It suggests the core remaining business is structurally more profitable.
Okay, that makes sense. Now, moving down the income statement to operational performance, let's look at EBITDA, or FVUC as it's termed here.
Right. Earnings before interest, taxes, depreciation, and amortization, a key measure of core operating profitability.
Yeah.
What did that do?
It actually dipped slightly.
Yeah.
FVUC went from 11.4 billion TL in 9M 2024 down to 11.03 billion TL in 9M 2025.
So a small decrease in the absolute number, but what about the margin relative to revenue?
That's the kicker. The FVUC margin improved significantly. Sharply, actually. It jumped from 42.29% in 9M 2024
Which is already pretty good.
to 46.14% in 9M 2025.
Wow, 46% EBITDA margin. That is exceptionally strong for an energy company. That really speaks volumes about the profitability of their core asset base, especially those geothermal plants.
What's driving such a high, stable margin? Is there a specific mechanism protecting them?
Yes, absolutely. The key factor here is the Turkish government's renewable energy support scheme, known as Yekdem Yenilenebilir Enerji Kaynakları Destekleme Mekanizması.
The feed-in tariff system.
Exactly. It guarantees purchase prices for electricity generated from approved renewable sources.
Yeah.
But the crucial part for Zorlu is that for many of these Yekdem contracts, especially for assets like their big Kızılder 3 geothermal plant,
Yes.
the guaranteed revenue, while paid in lira, is calculated based on a price set in U.S. dollars.
So it's dollar-linked.
Precisely. This provides a very powerful built-in hedge against the depreciation of the Turkish lira and domestic inflation. It guarantees them a stable, high-margin income stream in real terms, regardless of currency fluctuations.
And how long does a Yekadem support last?
For Kızılder 3, which is a major profit driver, the dollar-based Yekadem guarantee runs until the end of 2027. That predictable, Forex-indexed cash flow is the absolute bedrock supporting that impressive 46% EBITDA margin.
Okay, so strong cost control and that Yekadem safety net help boost their underlying operational profitability. What about the next line down, operating profit, or İsas Faaliyet Kari?
That showed a really healthy increase, too. It went up substantially from just over 2 billion TL in 9M 2024 to 2.56 billion TL in 9M 2025.
So operationally, looking just at gross profit and operating profit, the picture is actually pretty positive, isn't it? Leaner, higher margins.
Exactly. If you stopped reading the income statement there, you'd think the company was doing great. The sale of the lower margin distribution business seems to have genuinely improved the quality and profitability of their core operations. They're firing on all cylinders operationally.
Okay, but we can't stop reading there, can we? Because then we hit the bottom line, and that's where the story takes a dramatic turn, the net period result.
Right. And it wasn't a profit. The group reported a significant net period loss of 4.5 billion Turkish lira, 4,502,522 KTL for the first 9 months of 2025.
A huge swing from the previous year, which showed a net profit of nearly 2.3 billion TL, 2,287,538 KTL. Although we have to remember the 2024 profit included the big gain from selling the distribution business.
Sure, that 2024 profit was boosted by the discontinued operations gain. But still, a 4.5 billion lira loss in 9M 2025 is a massive negative number. And this is the figure that really requires careful analysis for you, the investor.
So if operations are profitable, generating 2.5 billion in operating profit, where is this huge net loss coming from? It's clearly not the power plants themselves.
It's almost entirely driven by factors below the operating profit line, primarily the absolutely crushing burden of their financing costs.
Okay, let's break that down. Net financing expenses, how bad was it?
It was staggering. For the first 9 months of 2025, net financing expenses hit 15.47 billion lira, 15,474,931 KTL.
15.5 billion, just in finance costs.
Just in finance costs, that's up from an already high 13.3 billion, 13,292,817 KTL in the same period of 2024.
What's driving such enormous finance costs?
It reflects the reality of their massive debt load, a significant portion of which, including that big Eurobond, is denominated in foreign currency, mainly US dollars.
Right.
So as global interest rates have remained high, and importantly, as the Turkish lira has depreciated against the dollar, the cost of servicing that foreign debt, paying the interest, and accounting for the currency impact on the principal just explodes when translated back into lira terms.
So that 15.5 billion finance expense completely overwhelmed the 2.5 billion operating profit.
Absolutely, wiped it out many times over. And that wasn't the only hit below the operating line.
What else was there?
There was also a significant loss arising from the inflation accounting mechanism itself, TMS 29. It's called the net monetary position loss, or net parasol position KB.
How much was that?
That accounted for another loss of roughly 1.5 billion lira, 1,482,579 KTL.
And what exactly is that loss? Is it a cash outflow?
No, it's a non-cash accounting charge. Under TMS 29 hyperinflation accounting, companies holding more monetary assets, like cash, receivables, than monetary liabilities suffer a loss because the purchasing power of those assets gets eroded by inflation faster than their liabilities. Conversely, companies with high net monetary liabilities, like Zorlu with its huge debt, should theoretically show a monetary gain. The fact they showed a loss suggests complexities in the calculation, perhaps related to the timing of cash flows or specific asset liability structures. But the bottom line is, it's another big negative hit driven by the high inflation environment.
Okay, I have to challenge this a bit, though. If your finance expenses are over 15 billion lira and your operating profit is only 2.5 billion, isn't that fundamentally unsustainable? That $1.1 billion Eurobond might have pushed maturities out, but it didn't solve the underlying problem of just too much expensive debt, did it? How does management justify carrying that level of debt when it just obliterates profitability?
That is the absolute crux of the issue for investors, you're right. Management's justification essentially rests on the link between the debt and the assets. A lot of that foreign currency debt, especially the older project finance loans, was specifically raised to fund the construction of the very assets like Kızılderili 3 that are generating those high-margin, dollar-linked YIKDEM revenues.
So the argument is the dollar debt funds the dollar-linked income.
Exactly. There's a sort of a natural hedge, at least on the operational cash flow side, even if the accounting translation into lira looks awful due to depreciation. The Eurobond was critical not because it eliminated the debt, but because it bought them time. Extending the repayment schedule to 2030 drastically reduces the near-term cash flow pressure and the immediate risk of needing to refinance under duress.
So it buys them breathing room.
Breathing room to hopefully grow their other revenue streams like ZES, like the storage projects once they're built, like potentially higher domestic power prices post-YIKDEM, to a level where they can eventually cover these huge finance costs from operations alone. It's a race against time, essentially.
Okay, let's do a quick what if. We mentioned that 7.6 billion lira profit from the Dorad sale earlier, booked under investment income. What would the net loss have looked like without that one-off gain?
Right, good exercise. The reported net loss was 4.5 billion TL. The net gain from investment activities, mostly Dorad, was about 7.7 billion TL, 7,697,420 KTL. So, if you strip that out,
The loss would have been much worse.
much worse. The loss would have ballooned to roughly 12.2 billion lira for the 9 months, approximate netted for 4.5 BN, 7.7 BM.
Wow. So that door-ad sale wasn't just helpful. It was absolutely essential to keeping the reported loss from looking completely catastrophic. It was a massive non-operational subsidy to the bottom line this period.
That's a fair assessment. The asset sales were a critical part of their financial stabilization strategy, not just funding for new projects.
Okay, let's switch from the income statement to the balance sheet. Did all this activity, the Eurobond, the door-ad cash, actually improve their short-term financial health? Let's look at liquidity, cash position.
Yes, here the news is unequivocally positive. It's a major success story within the report. Their cash and cash equivalents, Nikit Benzerleri, surged.
Yeah.
They went from 1.93 billion lira at the end of December 2024 up to 5.92 billion lira by September 30, 2025.
That's an increase of 4 billion lira in cash on hand.
Exactly. That's the direct result of receiving the Eurobond proceeds and the cash from the door-ad sale landing in their accounts. Big improvement in their cash buffer.
What about net working capital? That's often a key indicator of short-term financial strain, the difference between current assets and current liabilities. Were they in deficit?
They were, and technically they still are. Current liabilities still exceed current assets. However, this is probably the most powerful indicator of the success of their restructuring efforts in this period.
How so?
The size of that deficit narrowed dramatically. At the end of 2024, their net working capital deficit was a worrying 8.4 billion lira, 8,438,389 TL.
That's a big gap.
A very big gap. But by the end of September 2025, that deficit had shrunk all the way down to 2.4 billion lira, 2,425,483 TL.
So they closed that gap by 6 billion lira.
Almost exactly. Reducing that short-term funding gap by 6 billion lira is a fundamental improvement in their liquidity position and their resilience to short-term shocks. It gives them much more breathing room day to day.
Okay, let's pull back and look at the total debt picture again. We know the Eurobond pushed maturities out, but the report shows total financial borrowings are still hovering around 57 billion lira, 57,002,559 KTL, as of September 30th. That's basically stable compared to year-end 2024 in inflation-adjusted terms.
Right. The absolute level of debt remains very high. The refinancing didn't make the debt disappear, it just rescheduled it.
So the key question for you as an investor is that level of debt sustainable relative to their earnings? You need to look at leverage ratios.
Exactly. The most common one is net debt divided by EBITDA, or net debt FOVEC in this report's terminology. How did that look?
There was actually a slight improvement there. The ratio decreased from 3.56 times based on the 9M 2024 FFO.
Okay.
Down to 3.42 times based on the 9M 2025 FFO.
So a marginal improvement. 3.42 times net debt to EBITDA. What does that tell us?
Well, it tells us that their core operating cash flow generation, EBITDA, is just about keeping pace with inflation and the size of their net debt. The slight decrease is positive. However,
It's still quite high, isn't it?
it is. A leverage ratio of 3.42 is generally considered quite leveraged. It means the company remains very sensitive to changes in interest rates, currency fluctuations, or any dip in their operating performance. There isn't a huge amount of wiggle room.
And they still have those domestic Turkish lira bonds coming due relatively soon, don't they? Separate from the big euro bond.
Good point, yes.
Yes.
That's often overlooked. The report details their outstanding domestic bond stock. It totals about 4.5 billion lira, 4,537,090,000 TL, with various maturity dates stretching out through 2026.
So while the massive dollar refinancing cliff has been pushed out to 2030 thanks to the euro bond,
They still need to manage these upcoming lira bond maturities over the next couple of years. It's smaller scale, but still requires attention and available liquidity.
right. Okay, let's talk about equity as Kanakler. We saw that big net loss on the income statement. How did that flow through to the balance sheet and impact shareholder equity?
Directly, as you'd expect. Total equity attributable to the main partnership decreased over the 9 months. It went from 73.56 billion TL at the end of 2024 down to 70.69 billion TL by September 30, 2025.
So about a 3 billion lira reduction in the equity base.
Yeah, and that erosion is pretty much entirely attributable to that 9M 2025 net period loss we discussed.
And for you, the shareholder, this matters because it shrinks the book value of your investment and theoretically, the capital base the company has available for future growth or dividends. Although the total equity base is still quite large thanks to accumulated profits and revaluation gains from prior years.
Speaking of dividends, it's worth reminding listeners that no dividend was proposed or paid out based on the 2024 results due to the losses incurred then. And given the 9M 2025 loss, a dividend based on 2025 results seems unlikely too.
Very unlikely, yes. Profitability needs to return first.
Okay, let's quickly recap the key financial ratios and then touch on one of those potentially important hidden assets mentioned in the notes, the investment tax exemptions.
Right, so key ratios. Operationally, things look strong. Gross margin improved to 15%. EBITDA margin hit that impressive 46.14%. The core business is efficient and profitable before financing costs.
But the net loss highlights the debt burden. Leverage at 3.42x is high but slightly improving. Liquidity significantly boosted by asset sales and refinancing, with the working capital deficit shrinking drastically.
A good summary. Now, tell us about those tax advantages. This sounds like a potential future benefit.
It is. The report notes that the group has accumulated a significant amount of carry-forward investment tax exemptions or incentives.
How much are we talking?
Just shy of 1.1 billion lira,
Mm.
1,098,235,199 TL.
Wow, over a billion lira in potential tax savings. Where do these come from?
They're generated from the huge capital investments they've made in the past, particularly in qualifying projects like the big geothermal power plants. These incentives allow them to shield future profits from corporate income tax.
And can they actually use them? Sometimes there are restrictions.
Management states in the report that they currently project being able to utilize 100% of this carried forward exemption against future taxable income.
So what this means for you, the investor, is that once Zorlu manages to generate sustained operating profits large enough to overcome those finance costs and actually show a pre-tax profit,
They effectively have a billion lira shield waiting to protect that profit from taxes. It could significantly accelerate the conversion of accounting profit into actual free cash flow for the company down the line. It's a valuable, though deferred, asset.
definitely something to keep an eye on. Okay, given the net loss, the high debt, even with the improved working capital, what's the official management line on the company's ability to continue as a going concern? Is there any perceived risk there?
Management addresses this directly in the report and is quite assertive. They state clearly that, in their view, there is no significant risk regarding the group's ability to continue its operations.
And what's their justification for that confidence?
They point to two main pillars. First, those guaranteed dollar-linked YEKDEM revenues, especially from Kızıldere 3, running until 2027. That provides a predictable inflation and forex-resistant cash flow stream.
The bedrock income.
Exactly. And second, the successful refinancing via the $1.1 billion Eurobond, which pushed major debt repayments out to 2030, providing crucial structural stability to the balance sheet. They believe they've managed the risks sufficiently to navigate the current challenging environment.
So the message is, yes, the numbers look stressed in places, but the core income is secure and the immediate debt cliff has been averted.
That seems to be the narrative. Okay, let's wrap up the analysis by looking forward. What are management's own expectations for the full year 2025? They provided some specific projections.
Yes, they did. These forecasts give us a sense of how they see the final quarter shaping up. For the full year 2025, they project
Okay.
electricity production sales between 2,200 and 2,400 gigawatt hours, GWH.
Right.
Commercial electricity sales between 5,800 and 6,800 gigawatt hours.
Wider range there.
Total revenue between 34 and 38 billion Turkish lira.
Okay.
And importantly, AFOVIC, EBITDA, between 11 and 13 billion Turkish lira.
Right. Let's pause on that FAUK target. They already achieved 11.03 billion in the first 9 months. So that 11 to 13 billion range for the full year implies quite a range for the fourth quarter, doesn't it?
It really does. If they only hit the bottom end, 11 billion, that implies basically zero EBITDA generation in Q4, which seems unlikely.
Highly unlikely given the first 9 months.
Right. But if they hit the top end of the range, 13 billion, that implies they're forecasting a very strong Q4 EBITDA of nearly 2 billion lira, 13 BPL, 11.03 BN. It is 1.97 BN.
So what does that wide range tell us? Are they just being cautious, or is Q4 inherently volatile?
Probably a bit of both. Energy production, especially from wind and hydro, can be seasonal, often stronger earlier in the year. So the lower end might reflect caution around potentially lower Q4 production or maybe weaker market prices.
Okay.
But the upper end, aiming for nearly 2 billion in Q4, suggests confidence. Maybe they expect strong performance from their trading activities, or perhaps continued cost control, or maybe even some contribution from those distribution-related activities still winding down.
And they also projected specific investments related to distribution for the full year, didn't they?
Yes, that was the final projection. 4.8 billion lira in total investments related to distribution for the full year 2025. This confirms that those Mustri Sözleşmesi'nden dönen varlıklar investments we talked about are indeed significant and ongoing right through to the end of the year, likely representing the tail end of their exit from that segment. #tag outro.
Okay, so wrapping up this deep dive into Zorlu Energy's 9-month 2025 results, it really paints a picture of a company undergoing a massive, well-funded strategic transformation.
Yeah, it's a tale of two halves almost. Operationally, things look surprisingly strong. They're leaner after the asset sales, and that core renewable business is churning out profits with an impressive 46% EBITDA margin, largely thanks to Yiğit-Dem. But the bottom line is dominated by that huge net loss, driven almost entirely by the immense cost of servicing their 57 billion lira debt pile, especially the foreign currency portion.
So the key insight for you, the individual investor trying to make sense of the balance sheet and activity report,
Is that management has very actively used major asset sales, selling off stable, lower-risk businesses like DORAD and distribution to generate cash.
not just for new investments, but critically.
Critically, to buy themselves time and stability on the debt front through that huge $1.1 billion euro bond refinancing, they've pushed the immediate repayment cliff out to 2030.
And they're pouring the remaining capital and future efforts into these potentially higher growth but maybe currently less profitable areas like energy storage, hybrid projects, and that big international bet with the ZES EV charging network.
Exactly. They've structurally stabilized the debt, for now, and are investing heavily in the future.
So they've bought time, they have high operational margins from the core business. What's the final, maybe provocative thought for our listeners to mull over as they look at Zorlu Energy over the next year or two?
Look, the strategic focus has clearly shifted. It's moved away from just growing revenue at any cost, which maybe characterized the past, towards achieving structural financial stability and improving profitability. They've managed the immediate crisis.
Okay.
Now, they possess some really powerful potential assets for the future. That stable Yiğit-Dem income stream until 2027, licenses for hundreds of megawatts of potentially lucrative energy storage, the ZES network as a growth option, and don't forget that billion lira deferred tax asset shield waiting in the wings.
Right.
The ultimate test, the real challenge for management, and the key thing for you to watch as an investor, is whether they can successfully convert all that future potential, the storage, ZES growth, the tax shield, into sustained current operating profit. Profit that's large enough, consistently, to finally overcome the persistent heavy burden of those finance costs.
And only then.
Only then can they realistically return to generating meaningful, distributable profits and maybe even dividends for shareholders. They've navigated the immediate storm by restructuring the debt, but that mountain of debt still defines their financial landscape for the foreseeable future.
A very clear summary of a complex situation. A company definitely in transition. Thanks for breaking down those numbers and strategic risks for us.
My pleasure.
And for everyone listening, if you found this deep dive into Zorlu Energy's financials valuable, please do help us out. Remember to follow the channel, share this analysis with others who might be interested, and subscribe so you don't miss our next deep dive.
Yeah, and maybe, as a follow-up thought, take some time to look into the competitive landscape for ZES Electric in those key European markets like France or Germany. Understanding the potential valuation of just that piece of the business could be quite revealing for the overall company picture.
Great suggestion. We'll leave it there for today. Thanks for joining us on the deep dive.